Joins us. Let's take a conversation forward, talk about fundamentals, market expectations, and what we should expect in terms of earnings season, which is about to start in about 3 weeks. Sanjeev, fantastic to have you back. Thank you for joining us. Sanjeev, if I would have painted a scenario, crude is above $65 and is refusing to come down. Bond yields or global bond yields have moved from 1% to 1.7%. And the fact that in India also inflation and bond yields are threatening to go higher. If I would have constructed a scenario like this, let's say in the month of Jan or Feb end, and if I would have requested people to predict the market level, they would have predicted levels of 12,000 and 13,000. But despite whatever has been thrown at us, both locally and globally, are you somewhere surprised with the market's ability to hold on?
Well, honestly, I'm not too sure about your conjecture about market being at 12,000 if, the bad news which is there currently was sort of put in place in February itself. I think anyway, both global and domestic markets have been anticipating this to some extent in the sense the increase in bond yields that's been going on for the last 2-3 months now. And if you look at India also, you have seen some expectations of increase in bond yields, and bond yields have actually gone up in the last 2 months now. So in a way, it's not really a big surprise that bond yields are going up, given the very low levels they were at and the fact that you are starting to see economic recovery both globally and domestically. Bond yields will probably move up. So nothing, really negative about that in that sense. What people are also factoring in at the same time is a recovery in the economy and earnings at the same time. So as of now, it seems to be some sort of if I can use that term, fight which is going on between bond yields on the one side and economic recovery and earnings growth on the other side. It seems like reasonably balanced at this point in time. So honestly, I'm not very surprised as how this market is behaving. So we'll see, how it pans out over the next few weeks, months in terms of the interplay between on the one side, inflation and bond yield expectations, on the other side, economic recovery, which is ongoing, and what kind of earnings growth and any earnings upgrades that we will see going forward. So let's see how this whole thing evolves going forward.
So my question, Sanjeev, is that what is next for the market? The fact that economy has recovered, we know that. The fact that demand is getting generated, everyone knows that. The fact that budget for the pro-growth and government spending will increase, everybody knows that. What is next for the market in terms of a trigger or in terms of an event?
Well, I guess the next 1 month will be fairly critical in the sense we will have some more visibility on what's happening on the COVID situation. So there also it's essentially a race between increase in cases that we are seeing currently, especially in the state of Maharashtra, and the vaccination rollout, which is also taking place at the same time. And let's see, how this whole situation evolves. But if for whatever reason, COVID situation gets out of hand, and you could see some pullback in the market, and on the other side, again, you will have some more earnings numbers coming out as the fourth quarter earnings results start coming out, and that will give us more confidence about what kind of earning numbers we should expect for FY22 and beyond. At the same time, you'll also get some more visibility on where bond yields are headed. So it's all really as of now, we'll have to wait and see on the one side what's happening to this whole COVID situation, which is actually a race between the number of cases that are going up and vaccination rollout. And on the other side, bond yields that could move up over the next few months from current levels. And at the same time, you will also see earnings being rolled over to the next year and so on and so forth as time goes by. So I won't be too perturbed as of now. Looks everything reasonably balanced as of now. Over the next 1 month, we will get more evidence which way this market should go based on what's happening on both the health outlook and also on the bond and earnings yield outlook.
How exactly do you see the banking space moving? One side is a proposition of a new credit cycle. On the other side, you've got a rising inflationary environment. You spoke about this so-called tussle between the inflation hawks and the growth propeller and the growth pundits. What impact do you think that will have on corporate banks?
Corporate banks, I think, are largely okay. You will start seeing some credit growth as we go along. It will still take time. Companies are just about starting to talk about investing. Government done a fair bit of good things over the past year and a half. So all that should result in eventually investment cycles starting to pick up. So corporate loan, which has been loan growth which has been fairly muted for the last several years, hopefully should start picking up. The real issue would be what's happening on the MFI space has also been in the personal unsecured loans, and that's where the concern would be if this COVID situation goes out of hand. We could actually start seeing concerns around the asset quality in both the MFI book and personal unsecured loan book, and also parts of MSME book starting to come back, which could act as some sort of headwind for the banking sector, especially the banks who have more exposure to personal unsecured loans, MFI loans, MSME loans, and so on and so forth. So I think corporate loans would be broadly fine over here. Whatever bad had to happen largely happened. Most of the bad loans have already been recognized. Sufficient provisions have been created. Now let's see how the situation plays out on the MSME and the retail side. Until now, we were quite okay, given the fact that the COVID situation looked like it was coming under control. Economic growth was really coming back in a big way, and banks seem to have made sufficient provisions. Now with this second wave of COVID cases, we'll have to wait and see how the situation plays out. But the usual suspects, which is MSME, MFI, and unsecured loans to urban poor, those would be again the more riskier loans to focus on, and accordingly the banks who have more exposure, banks and NBFCs have more exposure to the segments, could see some amount of derating if the situation were to deteriorate from current levels.
Sanjeev, at a time when everyone was upping their exposure to cyclicals, even outside of financials, the looming uncertainty with regards to the second wave and even what's happening on the global front, as you've just described, does this lead to a need to sit back and reassess strategy? Are we in watch and wait mode? Is that what you would suggest? Or do you feel perhaps the picture is not likely to change all that much? Are you also looking at a big picture focus when it comes to cyclicals, financials and otherwise?
If you're looking at the next 1 or 2 months, clearly things are fairly uncertain, right? As of now, given the fact that you don't know how this COVID situation is going to play out. Hopefully, it won't be as bad as the situation in August, September, and we get away with a modest increase in confirmed cases, no big increase in mortality, vaccination rollout, happens, picks up space, and we are okay over the next 1 or 2 months. In which case you're back to essentially, buying the more economically sensitive sectors, which are banks, metal mining, real estate, and so on and so forth. But over the next 2 months, if the situation were to deteriorate significantly versus market expectations, then it is pretty clear that the economically sensitive sectors are going to suffer significantly. And in that situation, the usual defenses like consumer staples, IT, and pharma are the ones which are going to hold up or maybe even go up to some extent. So it's fairly uncertain situation as of now. In the next 2 months, we'll have more clarity. So I don't think one should be taking a very bold call as of now, keep the portfolio neutral to the best extent you can, and then take a call accordingly in terms of how the situation plays out. But if you are willing to overlook the near-term headwinds which will be there because of this COVID situation, then you use that as a buying opportunity. If some of the economically sensitive sectors like banking, etc., come down based on the concerns around higher, credit costs and so on and so forth, then you start looking at 1 year forward and use the opportunity to buy some of the names, which will presumably come back over the next 9-12 months, as and when vaccination rollout picks up in a big way. In 6-9 months, I assume a reasonably large portion of global population, as also India's population, will get vaccinated, and hopefully things will be under control once and for all as far as COVID is concerned over the next 12 months or so.
Okay. Sanjeev, while everyone's always looking for the multi-baggers or where perhaps there's scope for multifold growth, what according to you has been the most resilient, outside of, let's say, an IT, which we all have a very clear picture on, but what outside of that has really for you painted a picture of resilience, or, whether it be thematic or whether it be even, in terms of specific stocks? You may not like to mention specific stocks, but I mean, a certain profile of companies that have withstood, a difficult time like we saw last year and may continue to steadily provide returns going forward.
I think most large cap companies, and the quality mid cap companies are quite fine, I would say. Forget about the stock price performance, which was pretty much in line, with the markets. Initial concerns in the, March to June, July timeframe. And then, the market started factoring in gradual recovery in the economy and then a quick recovery from November. So that's how the market has played out. So keep that aside. But I think, the large cap companies, their competitive positioning clearly seems to have improved, because of COVID. The smaller companies or the companies in the unorganized sector, clearly they have a lot more challenges going forward. Plus the smarter companies who are able to capture on some of the trends that we are seeing in the post-COVID world, which is essentially digitalization, etc. Again, those will stand to benefit. So I think broadly speaking, I'm quite happy to, just have a basket of good quality large cap, mid caps, and, own them for the longer term. Business models are fairly resilient. Many of the companies have managed the COVID situation extraordinarily well. Many of them have cut costs significantly. We'll have to wait and see how much they will be able to retain. And many of them have been able to, do the digital transformation a lot faster than what we had thought earlier. We were thinking of, 3 to 5 year time frame for many companies to, roll out the next level of digital strategy. I think it's got compressed to 1 to 3 years now in most cases. Plus the usual things about, formalization, etc. All that is happening a lot faster now. I think the usual suspects, with good business model, with, decent business modes, etc., they are the ones who stand to benefit in this environment.
Right. Sanjeev, wanted to get in a sense as to whether or not you're deriving comfort from some of the other niche sectors, say fertilizers, agriculture, or even specialty chemicals, which has emerged as a very hot theme of late.
I don't know about fertilizers, we don't really cover any of the names over there, but yeah, specialty chemicals clearly it's been an outstanding sector over the last 5 years from, companies which were fairly small, 5-6 years back. Many of these companies have become, large cap companies now, which fairly, $1 billion, several $1 billion of market capitalization now. And the runway of growth seems to be fairly strong or fairly long for many of the companies, I would say. Given the fact that essentially they are, supplying intermediates or finished products either for the global agrochemical companies or global pharmaceutical companies, and some way Indian companies have managed to do the reverse engineering to produce chemicals at far lower cost compared to whatever companies are able to do in the West. So I suppose that process can continue for the next 5-10 years quite easily.
Where is it, that you're seeing earnings comfort, or more importantly, Sanjeev, what is it that you're penciling in when it comes to the next quarter earnings basis, what we've witnessed in the previous quarter? Do you think that sort of follow through in revenue growth, in margin comfort is here to stay? What is it that you're expecting?
We haven't done numbers for the fourth quarter, as I said, but obviously it will be a very strong, YOY growth, because remember last year, we had the last 15 days of March 2020, which were, sales were hurt because of the concerns around COVID, and eventually had the lockdown during the last 6-7 days of the last financial year, when you have a lot of, sales. Auto numbers were very depressed because you were seeing the transition from BS4 to BS6, so wholesale volume numbers were very low for both two-wheelers and four-wheelers. Oil companies had a big inventory write-off or loss in the fourth quarter last year because of collapse in crude prices. commodity prices were quite low compared to where they are. So, even on a YY basis, you will see outstanding numbers. I don't think, that is something which the market is that, worried about or focus on also, because that is largely priced in now. I mean, who cares about 21 numbers, to be honest with you? That's all done and dusted. But even 22 is largely factored in. And the more important thing would be, whether the 22 numbers come through or not. I mean, as of now, from what I understand, the street is looking at 30% growth in the net profits of the TFT index. We are about 26%, so fairly strong recovery expected. Obviously, on the back of depressed numbers, FY21 in several sectors, plus much higher commodity prices, and so on and so forth. So hopefully, numbers will come through. COVID outlook clearly, a little bit of a spanner, in the wheels. Unfortunately, as of now, we'll see, how that evolves next 1 or 2 months. Hopefully, the situation under control and the numbers come through. Otherwise, you could see some amount of headwind as far as the market is concerned, because those like bond yields are headed up higher. And if we don't get the expected earnings growth, then the market will start getting a bit worried about, the fact that bond yields are going up and earnings yields are not rising to the same extent, in that case. And you could probably see some of the derating for the market in that case.
Where do you see the current valuations in the entire consumer staple space will settle?
Well, there is a lot of value, to be honest with you. Most of them are trading at anywhere from 35 to 48 times or 49 times March 23 numbers now. Only good thing is, most of the stocks are trading at the same level where they were trading a year back. If you look at the pre-COVID 2-year forward valuations of the consumer staple companies, pretty much at the same level now. When I look at, sitting in March 21 on a March 23 basis, pretty much a similar valuation. So you have not seen any rating as far as the multiples of the consumer staple names are concerned. And maybe that gives you some opportunity, at least in terms of roll forward, assuming the multiples hold. You will make about 10-15% return over the next 1 year or so, as the market starts factoring in March 23 or March 24 numbers, as the case may be. If the COVID situation were to deteriorate, then we could probably see some extra leg for the consumer staple names in the short term. Not driven much by value, but more driven by the fact that these will be treated as classic defensive names. Again, the theme about pantry reloading and all the stuff will restart. You could see some of the food product companies starting to see some more interest on the back of worries about COVID coming back. But honestly, it's not as if there's a lot of value in these names. As I was saying, it's not as if they have derated over the last 12 months. Valuation is pretty much at similar levels compared to where they were a year back. So only with respect to the market, you would have seen some derating, because many other sectors have actually seen a derating over the same 12 months. If I look at the same 2-year forward PE or EBITDA basis, you have seen a derating in at least in the IT names and pharma also to some extent.
Sanjeev, there are two mega trends, if I may use the word mega trends here. One is EV, the way how the entire EV ecosystem will get created, and second is that how does one bet on the entire data migration theme which is getting played in banks, or for that matter internet companies, or for that matter even on the lines of AI and even system integration. How do you propose one can bet on these two themes?
Very hard, to be honest with you. For example, EVs, I don't know whether we will have any Indian companies who are really successful in making batteries which is core to EVs. We have a few companies who seem to be doing the right things. I can't talk about, some of these companies, because we are doing the IPO of one company at least. But we'll see, how this progresses, because as of now, we have really no core capabilities as far as battery technology is concerned. And come to the other part, Again, I really have no answers to that here. I assume most of the smarter companies will be able to use data a lot better compared to other companies, whether it is banks or some of the e-commerce type companies. They will be the ones who will be having a lot of data and will accordingly use it, to offer more targeted products and services to their clients.
Just to wrap it up, Sanjeev, with one more powerful theme which in a sense was evident when markets bottomed out was pharma. And it started with first diagnostic companies, then moved on to the generic companies, and then specialty pharma, and also you had CRAM companies which in a sense joined the party. Suddenly pharma has taken a backseat. Is this market rotating or pharma stocks have run their course?
No, it's a usual thing here. When the first fall in the market, everything came down, and then people started realizing that okay, fine, things are not that bad. Consumer pharma, IT companies are not that affected. If anything, you would actually see higher sales for some of the pharmaceutical and healthcare companies, especially the pathological lab companies. So you started seeing some amount of quick rebound in those names, and as the market got more confidence about the overall COVID situation not being a very bad thing as far as the economy is concerned, we started seeing most of the other sectors also rallying after that. After the initial rally in the consumer staples and pharmaceutical names, which happened till I guess May or June of last year. After that, the more economically sensitive sectors started performing. So we have seen the usual, rotation, and towards the end of last year, that is starting from, I would say, end October, early November, you had all the economically sensitive sectors, which are banks, NBFCs, real estate, metal mining, capital goods. They were the biggest performance. So I guess now, everything is looking reasonably fairly valued. You don't have a lot of mispricing in the market in that sense. Over the next month, if you see some correction in some of the economically sensitive sectors, you could possibly see some value coming back in those names. On pharmaceuticals specifically, I think if you take a slightly longer term call, that is March 23, March 24, and there is a reasonable amount of earning visibility for the pharmaceutical companies, I think they are quite okay to own at current levels. We have seen some relating in the multiples over there. But not that much, I would say, compared to the IT companies. I mean, if I remember correctly, most of the pharmaceutical companies were trading at about 14 to 17, 18 times on a 2-year forward basis about a year back. Now they are in the range around 17 to 21 times. So looks okay, I would say, in the context of how much the rest of the market has also correlated over the same period.